I am super excited to talk to you today because this video's subject is about something that I think has absolutely transformational power in people's financial lives, and that is investment real estate. These days, when investment real estate comes to mind, many people immediately start thinking about owning an Airbnb property. That can definitely be a great form of investment, but the best use of a property is really determined on a case-by-case basis, which is why today we are going to discuss many of the things you should know and consider when it comes to deciding whether to turn your property into an Airbnb or a traditional rental. Let's dive into it. We are going to assume that your goal for your investment property is to maximize the return, which is why the first and main section of this video is going to focus on the financial considerations of an Airbnb, which we will refer to as a short-term rental or STR, and a traditional or long-term rental. But there are some logistical considerations as well, so the second part of this video will focus on that. I also want to mention that running these scenarios out on a property is important and worth the time, because although you can usually make more money with a short-term rental than a long-term rental lease, that is not always the case. While some properties, you might think they won't have short-term rental demand, they really could end up surprising you. Okay, first up, financial considerations. We want positive cash flow on our investment properties, so we need to understand the income potential and costs associated with each of our two rental options. For this, I'm going to use my current home as an example and case study. So in this corner, we have the income potential of a short-term rental. Although impossible to know for sure, there are a few ways to predict how much money a property can make as a short-term rental. The first and probably best way is to use AirDNA. AirDNA is a data company focused on the short-term rental industry. You can sign up and pay them for data, but for our purposes, we're just going to use their free Rentalizer tool, which takes their mounds of data on Airbnb and predicts your property's income potential. So I'll put in my address here, put in the correct info here, and calculate the income, which AirDNA estimates to be $60,000, which comes out to $5,000 a month. For my purposes, that's what I'm going to go off of, but I do want to quickly mention two other ways you can estimate potential income for your property. One of those being just to research it by yourself by being a snoop on Airbnb's website. See what others have charged in your area and look at how many dates are blocked off on their calendars to get a little bit of an idea for how much they are being booked. The other way is to contact a property manager who specializes in short-term rentals and ask them about the income potential of your property, but be aware that they may just use the AirDNA as well to whip up a quick estimate because it's a pretty popular tool in the industry. For figuring out how much money your property will rent for with a traditional longer-term lease, use sites like Zillow or Rently to see what other similar homes in your area are asking for. This should be easier to figure out than with the short-term rental option. And an alternative option for you is to ask a local property management company to run rental comps on your home, which I actually did, and I was told that my home could rent for $2,250 a month in this current market. So now we need to figure out the costs associated with each of our rental option so we can determine the cash flow. With both options, we as the property owners will obviously still have to pay our mortgage on the property if there is one. For this exercise, we will say the mortgage payment is $1,500 a month. Another cost that will stay the same either way is the HOA payment, which mine is about $80 a month. This is not an expense you pass on to even a long-term tenant because HOAs have just a crazy amount of power and they can actually foreclose on your home for late HOA payments. So you definitely don't want to put that power into the tenant's hands. On the short-term rental side, we have quite a few more costs to add into the equation. There's the fee that Airbnb charges hosts, which is 3% of the booking subtotal. With our estimates, this will deduct $150 from the monthly revenue. And as short-term rental hosts, we also pay for the utilities, which vary quite a bit throughout the year, but I'm going to do a rough estimate and say that they average at about $300 a month over the course of a year for my property. In addition to basic utilities, you'll also be expected to provide good internet, which around here seems to usually end up being around $80 a month. And you'll also need to take care of the landscape maintenance and the pest control for your short-term rentals. And because that can vary quite a bit, I'm just going to put $100 down a month for that category, and we'll call that good. There are other costs to consider that we won't put a number down on paper for right now, but we will mention them, such as the cost to have the property clean between stays, which you can pass on to the customers if you want to. The home also will need to be furnished, which can be a significant expense if it isn't already furnished, but fortunately that should be a mostly one-time expense. And if you decide to use a short-term rental property manager to make this a hands-off investment, they often charge anywhere from 12 to 20% of the gross revenue. And so in this instance, that could knock $1,000 off of the cash flow right off the bat. But since it's not required, we will say that I'm managing the property myself. Adding up all of the expenses gives us $2,210 worth of expenses, which puts the estimated cash flow at $2,790. Not bad if the estimate proves to be true. As for the traditional lease, the only expense we have beyond the mortgage and HOA payments is a property manager. For a traditional lease, I would use a property manager because it helps with your liability to make sure the lease is done right. And it's also very affordable. In my market, there are many property management companies who will manage a single family home for about $100 a month. Deducting the $1,680 in expenses on this side from the $2,250 in rent gives us a positive monthly cash flow of $570. Also not bad, but certainly not as exciting as the short-term rental side of the equation. Every property will be different, but one might ask, if the difference in this particular instance is so drastic, why would anyone even consider the traditional lease? Well, for one, it's guaranteed income. With a lease, you have a contract saying you will get paid this amount of rent. With short-term rentals, there's no guarantee that there will be future bookings bringing in more revenue. Also, that extra money, it's not free. There's a much bigger hassle factor with short-term rentals than traditional rentals. You have to facilitate the constantly changing guests as well as the cleaning, and there are other hassles such as the need to collect and pay lodging taxes in many places and municipalities. Furthermore, if you have seen my recent video on some data from Airbnb, you will know that year-over-year bookings are down in 2022 for Airbnbs. And I'm not sure if the estimates from sites like AirDNA are taking this into consideration, this whole recent shift in the market. I mentioned at the start that there is another consideration beyond the financial matters in this discussion, and that is the logistics of the rentals. Just briefly, I want to mention that in general, if you want a more hands-off passive investment, passive income being the financial buzzword lately, well, then in that case, traditional leases are typically a better option for you. You can mitigate the amount of work you put into a short-term rental through using a property manager, but that will eat into your profits and there will still likely be some additional hassle factor for you. If you're someone who greatly values consistency and certainty, that would be another reason to possibly use your investment property as a long-term rental. However, perhaps you like the property and you want to be able to personally use it. If that's the case, then you will want to have it be a short-term rental. You see this often with vacation homes where they will be rented out for profit, but the owners will then block off the dates that they want to personally use the property. That can be a great way to pay for a vacation property. There's tons to consider, and I'm sure I missed some things, but perhaps the most important thing for you to consider is to consider to subscribe to my YouTube channel. I work really hard to bring you valuable content, and I don't want you to miss my upcoming videos on different businesses and gigs that you can do to make more money. If you can please do me a favor and like the video, I would greatly appreciate it. And I do look forward to seeing you soon on my next video.